Netwealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Netwealth's. The guests, organisation and Netwealth have an arrangement for their financial products to be available for investment through the Netwealth platforms, and Netwealth may receive fees from the guest. More information about Netwealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
We are able to provide solutions to advisors and planners when it comes to building and establishing relationships with the next generation.
Those who can be reasonable cost but good on service are going to be the winners in the future.
That's my basic mantra. Investing generally is not complicated.
They wanted to support us, but they also wanted to see us succeed before they really gave us that support.
Hi, and welcome to Between Meetings with Matt Heine. In this podcast series, Netwealth's CEO and Managing Director chats to industry leaders and innovators with local and global expertise. They discuss the latest technologies, business models, and demographic changes, as well as leadership lessons and trends that are impacting financial services. We hope you enjoy their unique insights.
Hi, and welcome to this episode of Between Meetings. This is a special episode for two reasons. First of all, it's the 100th episode. So I started this podcast as a little bit of an exercise on the side, never think it would go anywhere, about 8 years ago, and pretty remarkable to think that we're now here today. Also special for another reason, which is we have a very special guest on today.
Indeed, you have.
Someone I've known for over 46 years, worked with for more than 25 years, and is, of course, Michael Heine, my dad. Welcome, Dad.
Hi, Matt. Good to be here. And as you can see, I went and bought myself a new suit so that I looked the part for this big interview.
Luckily, we don't have any photos or video of this to make to work out you were lying.
I've got my best jeans on anyway.
Indeed. And I think it's probably taken me 100 episodes to get the courage to do this podcast. So let's see how we go.
And I think it's probably taken me 100 years to agree.
Some people listening to this podcast would have a bit of an idea of the background to not only Netwealth, but also to the family history. So I thought this would be a great opportunity to hear it from you. And without going all the way back, love just to hear a little bit about, I guess, the lessons from history and what you've learned from your father, and then we can talk a bit about Netwealth.
That's a brave question, Matt, because, you know, when I get asked that question, I can go on for hours. So I hope the tape that we're using's got plenty of length in it. It's a fascinating history and a fascinating story. It's gone through ups and downs along the way, and we've ended up in this fabulous place that we are today. My father and my mother were both German citizens, both Jewish, living in Germany. And of course, with the rise of Nazism, that was a major problem. My father was in England at the time of the outbreak of war, and he was arrested as an enemy alien and sent to Australia on a infamous ship, prisoner of war ship called the Dunera, together with many other people that became well known, well respected, and in many cases famous. Once he got here, there was a bit of an outcry. It was eventually determined that being Jewish, he was actually on the Australians and British side. He was given the opportunity to join the Australian Army, which he did. When he was demobbed at the end of the war, he went back to the trade which he knew, which was trading. And whilst in Germany, it was a textile trading company throughout all of Europe. In Australia, he started to trade the goods that he could, wartime surplus goods, whether it was the wool off the barbed wire fence or canned goods out of the Sunraysia area, and started to build up a trading business exporting goods from Australia all over the world. That grew into what became Australia's largest trading company. And 46 years ago, when Matt was not quite conceived yet, we were doing about $500 million worth of exports for BHP steel alone to places like South America, to Eastern Europe during the communist days, to Western Europe, to Japan. He was very creative. He was dedicated to building up trade for Australia and developing Australian goods and commodities all around the world. We traded in wool and wheat and steel products, food products, a whole range of different products. One of the reasons that he was very successful was that Australia was a very insular country. didn't travel very much. The currency was pegged and the Reserve Bank would set the rate every day, not like it is now, a floating dollar. Australians didn't really have the expertise to trade overseas in foreign currencies, in foreign credit, providing credit to bankrupt countries like North Korea and North Vietnam as it was at that time. And so that provided us a real opportunity to dominate in the areas that we did. Over time, though, the Australian dollar was floated. Australian companies like BHP started to travel more and become more part of the world. And so the role of the trading company really started to diminish, and our competitors, such as the Japanese trading companies, purchased the means of production. So they owned the mines, they owned the steelworks and so on, which was not something that we were going to do. The lesson from that really is that we didn't look at our business early enough and strategically enough to say, the world is changing. Where are we going to go? How do we deal with this changing world? We should have looked at our business and made more strategic decisions about what to do rather than letting the trading business slowly wither and constantly cut expenses to meet the declining income. So that's one of my key lessons, I think, for all businesses is look at your business. Does it have a future? Does it have a growth potential? Or is it stagnating and going backwards? Many family companies fall for this and they just feel, this is what my father did. This is what my grandfather did. I've got to keep going, trying to make a success of it. No, my father would have been very disappointed if we hadn't changed direction and created something much more successful.
I unfortunately didn't get to meet your dad. I missed him by a couple of years, I think, but obviously a pretty remarkable individual. And the bit that you skipped over a little bit was the fact that when he arrived in Australia as a prisoner of war, he had no contacts, no money, and didn't speak English particularly well, and yet was able to build up this very substantial business. What was it that allowed him to do that gave him the mindset to actually go and recreate basically his whole life and be very successful?
It's a good point you make. And I should also note that when he was living in Germany, he was living in Leipzig, a wealthy part of Germany. His father had built a very successful business. They were the wealthy family in Leipzig. They had the chauffeur in those days. They had all the house staff. The butler would come in and open the curtains in my father's room and lay out his clothes for him. That was the life he lived for some time. And then suddenly in his early 20s, he's a prisoner of war, no assets, no contacts, no country, in fact, as you say. And he was stateless until he was granted Australian citizenship some years later. I think it's probably the story of lots of immigrants into this country, people wanting to achieve better for themselves and particularly for their children, that hard-working ethic that Australia was really built on. If we look around, so many of the Australian people were immigrants or children of immigrants, and they are really striving to provide a better life for those that come after them. And I think that was just part of the culture. Firstly, he'd come from a successful family business, so that was important, and he'd learned a lot there already. But also, having come from that, or even come from poverty, people are wanting to improve their situation. And he also was very desperate to provide a service to Australia, his adopted country, which became very much his country. And he wanted to give back to Australia. And a lot of what he did in building trade was always about doing the best he could for his country.
I often get asked what it was like growing up in our household, particularly when you were running Heine Management and the conversation around the kitchen table. Do you remember what it was like growing up with Walter as he was building this business from scratch?
He was definitely an interesting individual, multifaceted, like most of us probably are. He lived for business. He didn't really have a social life. Business was his one focus. His friends were people that came from the business world in the main. For example, I remember well, if we were in the office, when my brother Les and I were in the office working with Dad, every night when everyone else had gone home, come and talk to me. Come and talk to me in my office. And he would want to talk about business, and he'd want to talk about the things that had happened during the day, the things that were going to go on. So it was always very much talking about the business. I was very much aligned with his thinking. It was a tough business we were in. It was very competitive. He was very driven and very imaginative. The people he met always remembered him. He always made an impression. I'm not quite sure how he did that, but even today, 46 odd years later, I bump into people who will tell me about my father and the impression he made. One of my wife's children recently went on holidays with the Foxes, and Lindsay Fox today spoke of my father and what a clever, wise man he was. So it was quite remarkable. He lived for the business, and that's what we talked about to a large degree. But he also had a fun side and did silly things. We had a houseboat at Eildon after we had a farm up at Halkerdale, which people might know well. So we used to go horse riding, and we'd go skiing to Mount Buller. We replaced that with quite a different style. We went to a houseboat in Eildon, which you would well remember, Matt.
I do.
Much of your childhood and your brother's childhood was growing up there. So there was a bit of a mix, but he would do unusual things. We had an office in Moscow for some years during the communist days, and we had a manager there that probably worked for us, for the Australian government as a spy, and possibly for the Russian government as a spy also. So that's stories that I can tell at great length. But Dad was in Moscow, wanted an iced tea, and asked this fluent Russian speaker to order him an iced tea. And the manager came back and said, sorry, they don't do iced tea. So Dad doesn't take no for an answer. So he ordered a cup of tea, and he ordered a separate glass with some ice in it and some milk on the side, and he made his own iced tea. That was the sort of thing that he did. Another occasion up at Eildon, in fact, at the milk bar there, he ordered an icy pole, but the cold burnt his mouth. So he asked the shopkeeper to put it in the microwave for a few seconds, did that, bit into it, and burnt his tongue, of course, as it was so hot in the middle. So he was interesting, amusing, dedicated, focused. I also remember that I was driving along with some friends of mine in the school days with Dad, and my father was talking, and they'd have to turn around to me and say, what did he say? So he spoke English perfectly, but with a very strong accent, which sometimes was apparently hard to understand. Of course, as a child, having grown up with him, I didn't hear the accent. He just spoke the same as everyone else for me. But when you listen on tape recorder or friends listen to him, then you hear the thick German accent.
So like me, you never quite finished university and had one or two subjects left to go. What age did you start working with your old man, and what were those early days like?
Did you have to bring that up? But at least you admitted that you didn't finish university either. It's a sort of a regret I have today, because not for what I didn't learn, but more for not having those initials behind my name. And you will recall that when you started working, I told you wouldn't get a salary increase until such time as you got passed your degree.
And I'm still waiting.
And you're still waiting for that salary increase, but there's plenty of time left. I was a bad student in the sense that I studied only to pass exams, not for knowledge. And I'm not proud of that, but it's just a fact. And I found it very easy to pass exams, particularly in matriculation or even at university. You could review past exam papers, which was always something that you did as a revision anyway. But by doing that, particularly in the humanities, I was able to work out what questions they were going to ask this year. So I would study for those questions, and I'd get into the exam room and I'd have a quick look at the exam paper. Yep, they've asked me the right questions, because if they'd asked me anything else, I might have struggled. So I'm not proud of that, but it's the way it did work, and I did pretty well. I got a university scholarship in matriculation to go to any of the universities, Melbourne or Monash. Foolishly, Melbourne University was just up the road from where we lived in Kew. So I picked Monash, which was impossible to get to. Particularly the freeway wasn't open in those days. So it was quite a schlep out there. I was there during the revolutionary days, which were very interesting. The youth of Australia was revolting, maybe as they are today. Sometimes I think my children are revolting too, but it's a different revolt. So I was there, but I spent most of my time down at the Notting Hill Hotel or the Wheelers Hill Hotel, or at the races out at Sandown, and not in my lectures and so on. There was one subject, economic statistics, which I just didn't like, so I didn't even bother studying for that. That happened 2 years in a row, economic statistics 1. In the third year, I decided I'd actually better pass this, so I had a tute for about a week or 2 weeks, and found it was actually quite easy. So I don't know why I'd spent my time not doing it. But what that meant was that I was 1 or 2 subjects behind in my course. I finished a number of 3-year subjects, having been doing economics law, or economics jurisprudence. It wasn't a full law degree. But what happened was that my father was sick on one occasion, and he found that I was home a lot of the time if I wasn't down the pub. So he said, well, if you're going to hang around at home, you might as well come to the office and work. And he always had the view that he had a limited time and a lot to teach me. He wanted to use that time to the max. So I started going into work. And that's when my life really started, because instead of the theoretical subjects of supply and demand, which I think I know pretty well still today, it was actually practical application, and where you could actually see some results from what it was that you were doing. And that was really important to me. So once I started work, my life really changed, and I saw a future and had the ambition to keep growing and building that. I regret not having finished the course, because it would have been nice to have the initials. I think it's a bit late for me now.
But equally, I think in our defence, it was because we both started working and found it far more interesting.
Absolutely.
So you started at Heine with Les, I think at the time, and with Walter. You then had a whole range of different businesses and involved in food processing in England, and even owned radio stations around the country. What were some of your best and worst moments from those pre-Netwealth days, if you like?
Okay, this gets me to a point which is very important in my business philosophy. I had a debate with my father about the nature of the business we were in. We, as a trading company, when we did a deal, it was usually very substantial, both in the dollar amounts of the transaction and also the profits of the transaction. And that was fantastic. You build up to one of these deals, it would happen, and you say, oh, that was good. And then you'd suddenly realize the expenses of the company continued tomorrow and the next day and the day after that, but you didn't know where the next deal was coming from to actually pay the salaries and the expenses and the rent and so on. Didn't have computer expenses in those days. But I was always hankering for a business which had recurring income, where it was a consistent flow of business and not reliant on the one-off transaction. In our trading days, we would export for BHP Steel if they had surpluses because the domestic market was down. But if the domestic market was booming, they had no steel for export. So that concerned me. After the trading company really shut down progressively through sale and through closing departments, I started to look for the business that we might have for the future, which met my objectives of that recurring income. I did a lot of things, and I did a lot of things badly and learned a lot of lessons the hard way out of that. We had already, together with my father, built up a small mortgage lending business and property development business. And so we started to build further on that. My father died in 1978. That was already fledgling business. In 1982, we decided to actually go into the funds management business. So as we already had mortgage and property experience and expertise, they were natural products to go into. We established those businesses and continued to build those. But I hankered after more than that. And being a young and foolish man, I went into a whole range of other activities, and we bought some properties in Amsterdam, for example. As Matt said, we purchased a food processing plant in the UK, which supplied all the major department stores. I bought a printing company here in Australia, and we did a number of property developments. Timing was bad, focus was bad, management was bad. And instead of diversification solving a problem, diversification actually just amplified the problems. So when one thing went bad, they all went bad. Financial control was a key factor. A number of the businesses just didn't have the financial controls that are necessary. And that is a major lesson for everyone, to be on top of the finances and the cash flows at all times. But also spreading your attention across too many businesses can be a problem. Some companies have been able to do it. There's probably only one company that comes to mind that's been successful to date, and that's Wesfarmers, that have a range of different activities. But it's actually very difficult, and lots of companies have been diversified but failed over time. One of my favorite stories is when I became a media mogul for about 2 seconds. My friend Glenn Wheatley, who was also manager of John Farnham, came to me and said there was a radio station in Bega for sale. So we purchased that radio station, and he became a very small shareholder in the company that we had. That was going along pretty well. Glenn came to me and said 3CV between Bendigo and Ballarat is for sale. And we started negotiating that. And then all of a sudden, he said, by the way, Rod Muir, who'd bought Eon FM, of which Glenn was one of the founders, and he also had Triple M in Sydney, was looking to offload all his radio stations, and we should look at those. That was $90 million. And I said to Glenn, you're crazy. Why would anyone do something like that? That's a huge price for a couple of radio stations that really have no assets except a government license to broadcast. But I agreed that I'd have a look at the finances and arranged to meet the finance director of the Triple M group. I was waiting in a room, and there was a young girl there in blue jeans and Reeboks. And I was waiting for the finance director to arrive until I realized that this young girl was, in fact, the finance director, Trish Richards. And when she started to go through the numbers with me, I thought, wow, she really knows her stuff. She was amazing and really understood the finances very well. And suddenly I started to see the huge advantage of these radio stations. We ultimately agreed to buy the radio stations for $90 million. I paid $1 million deposit on the radio stations and arranged a capital raising in what was then a second board listed company, and arranged that cap raising and also debt financing from the State Bank of New South Wales to fund the whole purchase price. But before we settled, the Hoyts Media Group came to us and were very insistent that they buy the radio stations from us. We weren't really sellers, but when they offered $130 million, showing a $40 million profit on our $1 million deposit, we thought this was not a bad deal. So we grabbed that and agreed to the sale. I thought I was pretty damn good, a $40 million profit overnight, having done very little. But then I realized that on $40 million, we'd be paying about $20 million in tax. So I thought, there's a better way to deal with this. So I converted the $1 million deposit that we had already invested in the new company into a 25% shareholding in a company that was then valued at $160 million, giving us our $40 million equity in this company that was the preeminent radio station in Australia. That company was listed as Hoyts Media and then went on a buying spree and bought every radio station that they could put their hands on in every capital city of Australia. We then had the recession we had to have, according to Paul Keating, in the early 90s. Advertising revenues dropped to nothing. The expenses continued, of course, and the company ultimately went into receivership. And my $40 million amazing profit turned into a zero-sum game. There was the highs and then the lows, but at least it only cost us $1 million in the end. It certainly highlighted understanding the business you're in, understanding the risks you take, and importantly, understanding debt and the impact that can have on the upside as well as the downside. The early 90s were very tough. We had quite substantial funds management business also at that time, both in the property and the mortgage trusts. We dominated Australia in the mortgage trusts, but obviously property and mortgages all suffered during that recession, and we went through some real pain when these trusts were frozen, and then we had to ultimately list them. They were very, very tough times, but a lot was learned from there. One of the important things was that many of our competitors went to ground and wouldn't talk to their clients, to their advisors. We were out there very openly and very, very strongly talking to people, explaining the situation and ensuring that they were informed. And I think that stood us in good stead, albeit through difficult times. And an important lesson today, when things are tough, make sure that we're out there talking to people and keeping them informed and being honest and open.
I think one of the interesting parts of all of this is when you then went on to sell Heine Management in 1996. And for a lot of people on the outside, it looked like it was just a way to effectively create a liquidity event and to move on to the next thing, but probably was the result of a lot of the lessons and things that you'd been through over the last 10, 20 years. Can you just talk through what the process was there and how you came to that tough decision?
1999. Yeah. As we went through the recession and came out the other side and the business was still doing well, we were suddenly faced with a different problem altogether. And this was the trusts were all owned within a public company which we controlled. But Phil Green was a shareholder and a director. Phil Green was Babcock and Brown, and certainly he's experienced some tough times and learnt a lot of lessons, but he's one of the smartest people that I have ever come across. When he was in a board meeting, it was always interesting because he would always pose a question which no one had thought about before, and he just had an alternate way of thinking, which was really good. We had, by this stage, listed property trusts, and as a manager of a listed trust, you didn't have control of it. The shareholders were all equity holders through the stock exchange, and the equity could be traded overnight. All of a sudden, in the late 90s, these trusts became very valuable. We had taken over from a failed fund manager, the Ostwide Property Trusts. One of their trusts was called the Grosvenor Trust and held a third of Grosvenor Place in Sydney. And no one wanted to invest in that trust because a third of a building really didn't count for very much. By good chance, we were able to buy 120 Collins Street for what's now a bargain basement price of $286 million from Packer and Grollo. And we put it into the Grosvenor Trust so that there were two major Melbourne and Sydney buildings in this trust, which made it very attractive. One of our competitors, BT, came along one night on the stock exchange and bought up sufficient shares, units in these trusts on the stock market to then call a meeting of unit holders to remove us as manager and to appoint themselves as manager. This was a huge loss to us and really highlighted the risk that we had by not owning a substantial shareholding in these trusts. If you look at Westfield, for example, the Lowy family always held a very substantial ownership of the units themselves, not just the management company. Phil and I spent a lot of time trying to work out how we could gain control of these trusts with limited financial resources, because we had many billions of dollars of trusts and we didn't have a spare $1 billion to buy enough units to give ourselves control. So we were talking about this for some time. There was a lot of activity in the market where several trusts had taken over by majors, and we sat there with the potential to lose the business which we had built. And if I go back to look at your business and the strategy and is there a future, the answer was it was very challenging and we hadn't been able to find the way to protect this. Phil came to me one day and said, I've got a buyer for the business. And I said, well, I'm not quite ready to sell at this stage. And I said, but by the way, what price? And as soon as I said that, of course, I was gone. And so he gave me the price that had been offered. And I said, no, that's nowhere near enough. But it became a negotiation then. And we ended up selling to Mercantile Mutual, now ING, for a substantial price, $110 million. very substantial then and still today. And in their hands, the business basically declined over the next few years. So again, highlighting we made a good decision, but looking forward, what are the prospects for the business? What are the risks? What's the strategy for growing the business? We couldn't see one. So a sale was absolutely the right decision at the right time.
Imagine a world where wealth technology is simplified. Netwealth is continually investing in new tools and platform features to optimize your staff productivity and to give you and your clients the best user experience. With our managed accounts functionality, bring new efficiency and scale to your investment operations. A world of technology awaits. Discover it at netwealth.com.au/woo.
So at this time, you were 50-ish. You'd been in trading companies. I think there was mining in there somewhere. You'd been a media baron, mortgage funds, raised a couple of great kids. Most people would be absolutely exhausted by then, and yet you retired for 2 weeks and started Netwealth.
The only question I'd have is about the 2 kids, Matt, but no, they're all right. I was definitely not wanting to exit business, and when we sold Heine, the reason that the funds management business, the reason I was probably a reluctant seller was because I love business and I love the activity and I love the strategy, and I wasn't wanting just to retire. Having sold the business was the right decision, but then the question was, what now? And as you've often said, Matt, I don't play golf, so what does retirement mean? Well, I had my first game of golf in 60 years a couple of weeks ago. It wasn't so good, which reminds me why I shouldn't be playing golf. I sat at home for a couple of weeks investing some of the proceeds that we got from the sale and doing a few silly things, again, always doing silly things. I remember one of the deals I did was a currency transaction where it was a complicated transaction, which over the period of 3 months, if the Australian dollar went over a certain level, I lost my bet, and if it went under a certain level, I lost my bet, and I had sleepless nights and sweaty nights watching the dollar through the day and night. Fortunately, it worked out all right, but it wasn't sufficient that it was going to cost us all our money anyway. So always take a risk that you can afford, not one that you can't afford. And as my father always said, if you're taking this risk to try and survive, that's the worst possible reason to take a punt. And if you don't need to survive, then why take the punt as well? So don't speculate.
At that time, that was almost peak.com. And in addition to the currency trade, I remember you bought a couple of tech stocks. One went not so well and one went particularly well.
Yeah, you're quite right. I decided I was an entrepreneur and I put $1 million into 3 different stocks. One of them was a telco, which went broke in 6 months. And that was actually a godsend because there's nothing worse than watching a company going broke, taking years and years and years, and the pain and effort that you go to try and resuscitate it. So that was done and dusted. And once it's done and dusted, I can forget it and put it behind me. Whilst it's ongoing, then it takes a lot of emotion and hard work to try and rescue it. The second one was an asset consultant that we invested in, and it had a pretty good position in the market. And that company passed through many hands of companies that still exist today. Insignia owned it for a period, for example, and that investment returned probably a 7 or 8% IRR over a 4 or 5 year period. So I thought, oh, that's okay, but it's nothing special.
That was actually Intech, which ended up with Morningstar these days, I think.
I haven't followed where it's ended up.
Certainly went through
right.
Old Mutual, Scandia, and possibly Ibbotson and then Morningstar.
Okay, yeah. Your memory's better than mine for sure, in many ways. But it was okay. And by this stage, I'm thinking this PE, private equity investment game's not all it's cracked up to be. And the third investment was a company that was not listed, was in a new field. It was certainly .com type era. It was losing a fortune. And after I'd invested my $1 million, I kicked myself because how could I be so stupid to be investing in this company that just kept losing more and more and more money and kept raising more money to pay for its losses. I happened to invest in this company a little while after James Packer had invested in it. And it was a company that turned out to be Seek. My $1 million turned out to be about $20 million. So I thought, oh, phew, that was lucky, 1 out of 3. But it certainly highlighted the risk that you can have investing in these startup businesses. It was interesting, though, because through that, I became close to Paul Bassett, the founder of Seek, who today is Square Peg. And a lot of the things that he did when he was building up Seek were things that we learned from when we started Netwealth a very short time later. And so I saw that as not only having provided a very good profit return, but also having learned some very good lessons. And it was interesting that Seek actually was originally going to be a real estate business. And right at the last moment, they pivoted for various reasons and converted it into an employment site, and obviously done incredibly well. But again, showing the importance of pivoting and looking at your market and understanding your marketplace.
Not that REA has done so badly.
Correct. And that proves that there's room for many competitors in many of the different fields. REA and Domain have both done very well. But sitting at home trying to work out what we were going to build as our next stage, I reflected on a discussion we'd had at Heine Management before we'd sold it. Platforms were starting to become very popular and, in fact, were important as gatekeepers and a distribution method for the Heine products, for the Heine mortgage trusts and Heine mortgage property funds. We had looked at it at Heine and had decided that platforms was not consistent with what we were already doing. It wasn't aligned to that business, and therefore we wouldn't go into it. Not that it was necessarily good or bad, but just that it wasn't aligned with the business we were in. So we didn't proceed at that time. But with the benefit of a blank page, I suddenly thought, well, maybe this is the time that we should be looking at platforms again and taking a position. So together with the finance director from Heine and one of the salespeople from Heine, we sat down and started to think about building a platform business from that time. This is late 1999. My plan was that we would have 100 advisors with $30 million each, being $3 billion of funds under administration, and it would take us 3 years and we would invest $5 million to get to the break-even position. None of that turned out to be right, but in the end, it turned out way better than we could have ever dreamt of.
I think it was even broader than that. You were hoping to have about 10 staff and a pinball machine.
The pinball machine was definitely important because we were a .com business, and what .com business didn't have a pinball machine. We never got the pinball machine, by the way.
One day we will.
Yeah. I think because we're growing so fast, there's never room for the pinball machine.
But one of the names that might ring a bell to some people was Sausage Software, and Monitor Money, I believe at the time, which were some of the original suppliers when you started building out the platform in late 99, who were based over in Perth. Being the tech entrepreneur that you were, what were some of those lessons that you learned very early on when it comes to building tech?
We decided Monitor Money was a business in Sydney that was part of Paul Terry, and they had an administration system. We didn't want to build the administration system, the back end from day one, but we were certainly very focused on the consumer experience, the advisor and the client experience. So we went out to Monitor Money and Assure, as it was called, that part of the business, and arranged that we would have what's now APIs into their systems where they would do the administration, but we would build the front end. We went to IBM to ask them for a quote to build the front end for us, and they came back with $1 million quote, which I thought was absolutely outrageous and ridiculous. We eventually, in fact, found Method and Madness was the company which ultimately I think was sold to Sausage in Perth, and got them to build the website for us. I have a feeling it cost every bit of $1 million, but it was just drawn out and slow and didn't hurt quite as much as agreeing to $1 million up front. Today, I'm not sure we could build the front end for $1 million. We wouldn't get very far with that at all. We had the front end built and we interconnected it with Assure in Sydney, and that was good. But there was a fundamental decision that I'd made at the time. There was a lot of parties that were out there that were badging a BT or a Colonial or one of the other platforms businesses. So they were putting their name on a prospectus, and they were really a marketing organisation. I didn't want to do that because I didn't want to be the middleman. As I'd learned in the trading business, it's very hard being the middleman. You really need to control your own destiny. You need to control what it is that you're delivering to customers and building to their needs rather than to the needs and ability of your supplier. So that's why we actually went out and built our own website rather than just badging somebody. And I guess we had the advantage of having the money that we thought was going to be enough to build our own website and to build the business from scratch. Maybe that's where the entrepreneur comes in from time to time, that you actually have the belief in yourself that you can do it and are prepared to invest significant money in it. As it turned out, as you well know, Matt, it took us 63 months to get our first $1 billion of funds under administration, and it cost us $25 million to get there. It was just lucky that we had that money and were able to keep on investing. One of the things that I'm proud of today is that we invested $25 million in the business. We never borrowed to build the business. We never sought external capital to build the business. If we were going to succeed, it was on the basis of the money that we put in. And if we failed, it wasn't going to be somebody else's money that we were failing with. And that business, 25 years later, has a market cap of close to $8 billion, which I think is quite remarkable.
We'd actually invested more than we had under management, which was a pretty scary place to be. Can you remember what the discussions were? You always have run a good governance structure and had independent directors that actually gave you the confidence or maybe the stupidity to keep investing. And what was the point at which you thought, okay, we can beat the banks and the other institutions?
Yeah, they were pretty scary times at the time because whilst we'd sold Heine Management for a significant sum, it was not an endless amount of money. We didn't want to lose what we did have. When we started Netwealth, my brother and I, who had been joined at the hip in all of our family businesses up to that point, had gone our own ways and started to do our own things. We decided that when we started Netwealth, I invited Les to join, and he took a 40% shareholding and I had the 60% shareholding, and I was involved in the management and Les was not. The board, as Matt says, was independent. We had lawyers, we had accountants, we had bankers, we had a number of different people on the board, and the governance structure was always very strong from the beginning. So when we listed, people asked, was it a big step? The answer is no, because we were highly regulated and we had a high degree of governance built into the business. But every month at our board meeting, we'd be sitting there and the losses were growing and the funds under management weren't. So that was of concern, and we had to pivot from time to time and we had to work hard. And when you're building a business that relies on trust and confidence and financial acumen, it's very hard to get people to back you with their clients' money. So going to an advisor, and I knew many of the advisors because of the Heine Management Funds Management business, going to them and asking them for support. They wanted to support us, but they also wanted to see us succeed before they really gave us that support. And around that time, there were a couple of businesses that had started platforms where the administration got completely out of control and they basically failed, and it took administrators time to sort out whose assets belonged to who and where the assets were. There was no fraud, but there was a complete lack of financial discipline, which is, again, one of those things that I've spoken about, the importance of financial discipline. And even though our funds under administration were very small, we would balance our cash holdings every single day, not on a monthly basis as most would do, and the controls were always effective and we were always very strong in that area. But we would sit around that board table wondering what was going to happen. How do we change the direction? And we just kept on changing and pushing in different ways. And I spent a lot of time out talking to advisors, building those relationships, getting a little bit of support here and there. But I remember when the losses reached $8 million, my brother sat at the board table and asked, why are we continuing to invest in this? Surely we have to stop. And being bloody minded, I said, no, we'll do this. We'll get there. We'll be able to achieve that. And thank goodness that we did persevere, because we have the most amazing business today. There's a lot of doubt, and those people around the board table were right to question what was happening and how we were going to change things. But having a clear focus on what you're trying to achieve, working very, very hard, and being very focused on the client experience were all things that helped us build it over time.
So the answer might be the same, but when you reflect back on the last 25 years, notwithstanding a lot of hard work from the team and a fair bit of luck along the way, what are some of the things that you've observed when scaling a business? And we often talk about the fact that scaling a business is great, but it also creates a lot of challenges and needs to be managed very carefully. Is there any advice that you'd give to people that are currently in a growth stage?
Yeah, scaling your business can be a real challenge. It's very exciting, and you have to really balance the growth in the sales with the administration and the back office and the governance structures. It's not that easy, and it takes a different mindset to do it. And sometimes you have to think about the people that are running it, whether they are better at growing or whether they are able not only to grow the business, but to manage the expansion and the growth and the administration and the controls of the business. And very often, somebody that can grow a business, particularly from the sales perspective, is not the right person to take it on going forward in the future. I think it's really important to always have a team of people, and the key team, I think, is the managing director, the CEO, together with a very strong finance director, so that you have the person that is creative and pushing and expansionary, and the other person that's able to put some controls and some stops and make sure that the entrepreneur is addressing all the correct questions and really focused on the issue. I think that makes for the best combination in growing a business. I think the people that you have when you're a small fledgling business are often the right people at that time, but not as you grow and expand. And as you grow and expand, unfortunately, you have to evolve in a little bit more bureaucracy, a little bit more systems and structures, and that suits some people, but not others. So you do need to look at the situation and upgrade the people and create the governance so that the rainmakers can continue to grow and build the business and follow the dreams.
All great advice. I'm conscious that we're getting close to time. So before we go, a couple of questions. First of all, technology is moving very quickly at the moment. You love your tech and your gadgets. What's exciting you at the moment, and where do you think things are heading in the next 5 years?
Well, it was your brother's 45th birthday a couple of days ago. So his daughter and I went and bought him some Meta AI glasses, which I'm waiting for them to arrive in the mail any day now. Now, I don't know whether he'll get them or whether I'll play with them. Technology is fantastic. You haven't asked me for help on your technology for a little while, but it's not that long ago that both my sons would ask how to do something. I think that the internet and GPS have been absolutely fundamental to the changing world that we have. And we are in a world now which our kids just take for granted, but we look back on communications and think about the way we used to communicate. When you and I started the business, Matt, we would crawl under the desk of an advisor to plug in the phone line to a modem so that we could connect to a computer to show them a spreadsheet that was probably not even connected to the internet. And today, we've got a very different structure. Technology has changed dramatically, obviously. The cloud has been a significant change for the way we all operate. But the biggest change that is coming is AI. I don't think there's many companies in the world that can say that they have a really efficient, good IT stack today. Most because of the advances that are taking place, it's a constant scramble to keep up with where technology is and to try to keep current from an efficiency cost point of view, etc. But AI, without question, is going to be dramatic, and it's something that should be embraced, not feared. Every revolution that we've had over the centuries has led not to a decline in employment, but a growth in employment and new opportunities. And humans should use their brains for things that are valuable, not for things that are repetitive and recurring. I'm very excited by the future. Blockchain was something that was, and whilst we've got Bitcoin, blockchain was being heralded as the next big thing for many years. I'm sure it has a part to play, but I think the AI is going to leapfrog that in importance.
One of the other questions that I get asked quite a lot is, outside of Netwealth, what are some of your other business interests and how are you filling in a few more hours in the day?
My first and most passionate interest is Netwealth, where I continue to have a significant shareholding that I entrust to you, Matt, to look after and
doing a very good job
to multiply what we've achieved already. I do have investments in other things, and I love investing. Whether I'm good at it or not, time will tell. But I'm a bit contrarian, and you and I have had this debate for a few years now. I have invested a lot in private credit, but I think what's important there is to pick the manager. I don't like going into funds particularly because I think I've got enough experience myself to be able to pick out individual transactions and to decide, do I want to invest in this one or not? But I also want to invest with a manager that has the ability to get out of trouble, because people will get into strife, and it's important that the manager has the experience and expertise and the resources to be able to work through a problem mortgage loan. Not forgetting that we ran a very substantial mortgage book for many, many years, including through the big recession periods. I've invested in some private equity businesses, a variety of them. One that's already exited was a plant hire business where it was a couple of years and probably trebled the investment there. I have investment in recycling of building materials for road construction. I have a investment in, this is actually we have, Matt, I should be saying, because it's all in the family trust, in a business that manages the advertising content and compliance for automotive companies around the world. I have engaged in a number of property developments, industrial property developments particularly, and self-storage businesses, which are all very interesting businesses. When interest rates were at zero, I decided to proceed with an office development in Melbourne, in outer suburban Melbourne. I thought it was better to have bricks and mortar, to invest the money in bricks and mortar than having it sitting in the bank at zero. That wasn't such a good investment decision. And a couple of years after completion, the building is still substantially vacant. We're working hard to fill it and providing incentives, but it's going to be some time, I think, before the commercial property market comes back. And I personally think that work from home is here for good. We've got to find that balance. So there's a surplus of commercial space today, and it'll take some years before we can start to build on that existing availability. And it's certainly not profitable. You can't build for the price that's needed today. I'm looking at investing in retail shopping centres as long-term secure investment. There's a lot of different investments that I'm looking at. I do look at a couple of individuals. Craig Winkler founded MyOb and was successful in building a very substantial business there. And although he didn't want to sell, he was forced to, through an aggressive takeover bid, and made his billions. He then invested $17 million, I think, in a company that was a startup called Xero, and he's made his further billions in that. I look at Hungry Jack's, who built a very successful fast food business, made his fortune there, and then he invested in Domino's Pizza, which again was very successful. So out of all of those different things that I'm looking at, Matt, I'm hoping that we might find the next big Netwealth come out of there somewhere. But I think our big focus is on continuing to grow Netwealth, continuing to look after our clients, continuing to lead the market, And you're doing an amazing job there together with a very substantial team now.
That's fantastic. We've run out of time, unfortunately. I'm sure there's lots of other questions we could have explored, but some great stories. Most of them I've heard before. There were some new ones in there though, so thanks for that. Look forward to many more years of successfully building Netwealth.
Thanks, Matt, and keep up the fantastic job that you're doing.
Thanks for listening to this episode of Between Meetings. For more episodes and to subscribe to our series, visit the Netwealth website, iTunes, Spotify, or your favourite listening service. And if you want to contact me or engage or discuss any of the topics raised, please find me on LinkedIn or Twitter or send me a private message. We hope you can tune into the next episode.